Welcome back to Alpha Recap, your weekly market rundown from stockalpha.ai. Markets closed mixed today, and we've got a dense research week to unpack. As always, if you have questions, you can reach us at stockalpha.ai and use the Q&A feature to ask directly.
Hey, glad to be here. We've got AI demand, yield rotations, binary events, and a whole lot of valuation tension to chew on. So, what really stands out here is how AI showed up everywhere this week.
Right. Chips, cloud, software, even utilities. Analysts were unanimous. AI workloads are the primary secular growth engine across the board. Let's start with the big picture. The research flow basically pointed at three parallel themes. First, explosive AI demand. Second, a search for income and defensive yields. And third, event and policy risks that create one-off moves.
Yeah, exactly. And the messy bit, the tension, is that many of the AI winners already trade at premium multiples. So the upside is priced in for some names.
Take NVIDIA. Analysts still called it a market leader with massive AI infrastructure exposure, but the note flagged that the stock was priced for perfection. The report listed its market size and consensus upside at about 49%. And that valuation shows up across semis and cloud names.
Which is wild when you consider NVIDIA's scale. About $4.3 trillion in market value in the note. I mean, when you step back and look at this, that's enormous.
And that's exactly where the valuation pressure conversation starts. Lots of names have AI demand, but their multiples vary wildly. Some justified, some stretched.
Right, for example, Broadcom and AMD were flagged as having high multiples. And Snowflake was called out for sitting at a pretty stretched enterprise value to revenue multiple, about 12.9 times in one note.
Snowflake's case is classic. Strong revenue growth and AI tailwinds, but negative GAAP profitability and a valuation that assumes pretty fast monetization of AI workloads into recurring revenue.
So it comes down to timelines. How quickly pilot projects convert into recurring ARR. Some analysts are optimistic for Google, Microsoft, and NVIDIA. Others want to see durable cash flow before signing off.
Let's flip to the income story. There was a clear rotation into yield. Energy, telecom, utilities, and some industrials. Dividend narratives are acting like ballast as geopolitical noise buzzed in the background.
Yeah. Verizon was called out with a dividend around 6.4%, BP around 5%, and Dow in the 4 to 4.5% neighborhood. Those are attractive yields when uncertainty spikes.
And NextAir Energy got interesting coverage, oddly positioned as both a utility and an AI beneficiary because data centers are big incremental electricity customers. It's a dividend plus growth story, but with CapEx and potential dilution to watch.
Honestly, I was a bit surprised by the utility angle at first. Utilities as AI plays. Not what my mum would expect.
Right? But it's sensible. Compute loads need power, and if hyperscalers keep building, that's steady regulated demand for utilities that can serve data centers.
Brief reactions.
Short reaction.
Right.
Okay, event-driven stuff next. The research emphasized that a lot of near-term moves are binary. Cannabis policy, phase 3 biotech readouts, takeover chatter, and legal headlines.
MSOS, the US cannabis ETF, got the usual treatment. Concentrated risk, policy-dependent upside, so the stance was neutral. Same for SELLAS Life Sciences. Huge binary risk around its Regal phase 3 readout.
And Warner Bros. Discovery was trading on takeover talk. A classic event where regulatory filings or break fees could swing the trade heavily.
Put simply, you separate event trades from your core holdings and size them tightly. Scenario planning is essential. People were urged to do probability-weighted outcomes for biotechs and policy plays.
All right, moving into execution and CapEx. Large platforms are pouring money into AI infrastructure. Amazon got called out for multi-hundred billion AI infrastructure spend. Oracle and Salesforce are pushing AI product lines. All of this raises a margin trade-off.
Yep, CapEx heavy now to get optionality later. The tension is that heavy investment can pressure margins in the short term, and analysts are watching quarterly guidance and free cash flow conversions as leading signs of sustainability.
Exactly. The notes repeatedly warned that earnings beats alone won't fix stretch multiples. unless cash flow and margin durability show up. That's the "don't get fooled by one quarter" message.
Quick point on semiconductors. It's not just about GPU makers. TSMC was discussed as the fab's beneficiary, scaling AI chips, but geopolitical risk was a big caveat. So owning semis is nuanced. Supply chain and geopolitical cadence matter.
Let's run through some company highlights. Quick hits with the tone from the research. Ready?
Ready?
Merck. Bullish because of oncology momentum and AI partnerships. The note put its price to earnings in the mid-teens and flagged durable upside.
Costco. Membership moat, steady free cash flow, but valuations felt high in some models. Stances ranged from neutral to hold for traders, buy for long-term investors.
Visa and MasterCard. Both got praise for optionality with stablecoin and crypto rails. Visa was called bullish. The idea is payments networks can re-architect rails, not just collect tolls.
Interesting contrarian thought there. Payments firms as active infrastructure builders rather than passive processors.
Energy names like Exxon and BP got mixed takes. Near-term cash flow tailwinds from oil shocks, but a neutral stance in many notes because commodity rallies can reverse quickly.
A reminder to be conservative with windfall profits. Analysts looked for balance sheet signals and whether management used extra cash for buybacks or capex.
Banks. JP Morgan was bullish as a core bank, with yield and value stories. But reputational and legal headlines for other banks were flagged as risk drivers to monitor.
Crypto names like Riot Platforms and the big corporate Bitcoin accumulator were described as neutral. They carry optionality, but high correlation to crypto price swings.
Tesla got the usual optionality chatter. Robotaxi dreams versus stretched valuation. And Eli Lilly was noted for GLP-1 leadership, but again, multiples are rich.
Another short reaction? Right. Yeah, that tracks.
Now, a few cross-cutting patterns the research teams emphasized. First, AI is not a mono trade. You can get exposure via GPU makers, cloud hyperscalers, data platforms, or even utilities and industrial equipment makers that support data centers.
Second, valuation dispersion is huge. Two companies can get the same AI lift, but trade at very different multiples depending on profitability, capex needs, and cash flow timelines.
Third, income versus growth bifurcation. Investors were rotating into income names as a defensive posture, while also keeping conviction capital in select AI leaders like NVIDIA, Google, and Microsoft.
And finally, event and policy risk amplifies volatility. So separate your event trades and use stop discipline. That's practical, not academic.
Let's make that practical for listeners. Portfolio implications. Build a thematic core to capture durable AI winners and complement it with small, event-driven satellites sized carefully.
Yes, and use high-yield defensives as ballast. Verizon, Exxon, BP, and select utilities were highlighted as shock absorbers, but watch their execution and balance sheets. CapEx for next era, leverage for some industrials.
Also track CapEx signposts closely. With platforms spending heavily, free cash flow conversion and guidance are your early warning signals. If CapEx keeps rising and margins don't follow, valuations will be tested.
And don't fall for single metric narratives. Premium multiples need to be justified by multi-year cash flow trajectories. Revenue beats without margin improvements won't cut it for some of these names.
Now, quick look at what the research said to watch next week. Oracle earnings on March 10th was top of the list. The street is focused on AI CapEx guidance and government contract updates.
Celus's Phase 3 readout is another big one, a classic binary event where position sizing and stop discipline matter. We'll publish scenario notes as soon as that readout drops.
Also monitor oil and any Gulf supply shock follow-ups for BP and Exxon, plus any regulatory filings or deal updates for Warner Bros. Discovery and Paramount Skydance chatter.
And keep an eye on NVIDIA order flow and H200 production in China. Supply chain tweaks could spark short-term volatility in semis.
A couple more tactical pointers from the research. For retail, March Madness impacts DraftKings. And keep attention on Nike for FIFA comments and Costco traffic metrics if there's a pullback.
Good checklist. For banks, Watch legal and reputational headlines, as well as AI integration wins that could reduce costs over time.
Time for our closing synthesis, the short version. First, AI demand is structural and cross-sectoral. Second, investors are rotating to income for stability. Third, event and policy risk are creating attractive but risky satellite opportunities.
So the practical takeaway: allocate conviction capital to a select group of AI leaders where you can see multi-year cash flow, and use yield and defensives to absorb shocks. Keep event trades small and strictly managed.
And remember, strong narratives like AI, electric vehicles, or GLP-1 don't guarantee short-term outperformance if execution, CapEx, or regulatory timelines slip. Stay humble and watch the signal-rich events next week.
Final thought: diversify how you play AI. GPUs are one route, but so are cloud platforms, data center power providers, and software firms that can actually monetize AI into recurring revenue.
Right. Before we go, 3 crisp takeaways. 1. AI demand is real and broad, but pricing already reflects a lot of that in some stocks. 2. Use high-yield names as ballast in uncertain times, but monitor execution. 3. Treat event and policy trades as satellites with strict sizing.
Short sign off.
Thanks for joining us. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.